right here. So what we're going to be looking at tonight basically is a strategy that could be used for trading pound USD. Pound USD is one of the very well traded, currency pairs out there. It is otherwise known as the cable. I love pound USD myself. I love pound USD. It's known as the cable. I mean, some pairs do have, aliases. The Canadian dollar is known as the loonie. Don't know how they came up with some of those crazy names, but that's fine. So what I want us to do, you can see the lines, these vertical lines, which we call period separators. This is the 4-hour time frame. We are going to be working, or at least starting off on the 4-hour time frame. Let's go to the 1 hour anyway. You can see the period separators are still there. To apply the period separators, to put it on the chart, you basically click and hold down Control and then Y, or you press Control Y at the same time. It comes on, off, so on and so forth. So on the 1 hour time frame, from one period separator to another, basically is a 24-hour period. It's a 24-hour period. At the line is basically the start of the end of the New York session and the start of the Asian session. Well, we will call it Asian session, but really it's the Aussie session. The Aussie session starts, and after about an hour or so, the Asian session starts. That's the way it is, really, technically. Even though everybody calls it the Asian session, they kind of like lump both the Asian session and the Aussie session together, which is, I suppose, it makes it easier for everybody. Just like, you hear people talk of the London session. The London session starts at 8 a.m. UK time. That's when the London session starts. It is otherwise known as the European session. Some people call it European session, but really the London session starts at 8 and the Frankfurt session starts at 7. That's the way it is. Frankfurt starts at 7. An hour later, the London starts. But people will tell you the European session starts at 8. Some would say 7. We're not going to get it all mixed up, as long as we know which session we want to trade. So when you have this line on the 1 hour time frame, that's basically when the Asian session, let's just call it that, that's when the Asian session starts. What you want to do is, if you go to the 4 hour, you can see 24 hours on the 1 hour. So what you want to do is to come to the 4 hour, and the first 2 candles is what you want to work with, or you want to start working with this strategy. It's been effective and proven to work mainly with the pound USD, mainly with the cable. But like I always say, whatever strategy we teach, try it on some other pair. If it works, fine. If it works, fine. But sometimes, one could not be bothered, trying some strategies on other pairs. One strategy I do know works for all pairs is my pair packet is the harmonic patterns, also the head and shoulder. So some strategies work for all pairs, all assets, but there are others that work for only, or work best, with only select assets. So let's go with this one. We're going to, have a couple of examples. This was the last one we would have been able to work with on Monday. So that, would be the beginning. You know what, let's see if I can do something here. 1 minute, let's bring up another chart. 1 minute, 1 minute, 1 minute. Okay, where are you? Oh, okay. I don't think I have. Do I have it on this? Oh, I do. Brilliant. I'm trying to bring up the game changer. Trying to bring up the game changer. Okay. Let me take all the indicators up. We don't really need them. We'll leave that one on. Okay. So that's game changer. We're going to alter some stuff there. We don't want to. Let's take this off. Okay. Okay, so let's go back to the 4 hour and pull up the period separators again. So we can see what's happening here. I mean, I basically pull up the game changer so we can see the days. So you can see here, if we go to the 1 hour, between one period separator and another on the 1 hour is 1 day. So that's Wednesday, Thursday, Friday. So if we go to the 4 hour, you will see it's for the whole week. So basically what you want to do is to mark this up at the beginning of the week. So when the market opens tonight, for those in the UK and in Nigeria, you would obviously have to let these 2 candles play out. This red one, well, okay, fine. It's not going to be this one now. This was for last week. So by the time the market opens today, when the candles have painted on the chart, into the next week, the market opens at 10 o'clock Friday. Sorry, 10 o'clock tonight, UK time. When the candle has painted, when it's painted 2 candles on the chart, by tomorrow morning, you'll be able to mark it up. So let's work with last week. I mean, we're going to try out some examples. Like I said, we're going to work with last week, the week before, and maybe the week before that. So what you want to do is to let when the market opens at the beginning of the week, you will let the first 2 4-hour candles paint on the chart. This is a 4-hour candle, obviously, because we're on a 4-hour time frame here. And this is a 4-hour candle. So you will get the low of the 2 of them. You get the low and the high. So let's get the high. I mean, we can see, the high of the 2, it's here. So we mark it there, like so. And then we'll get the low. Let's make it bigger so we can see it clearly. And we'll get the low. I mean, I think this is lower as well than, I think the bullish candle is lower. So we will use that as well. Yeah, so we'll use that as well. So basically, you've chosen the high and the low of the 2 candles. Never mind, any other candle. You are just working with these 2 candles. The candle that it is on the line here, on this vertical line, the period separator, and the next one. What I would usually do anyway, because sometimes you'll find that when you change time frames, this horizontal line would disappear. Let's try. I mean, it might not disappear now because its market is closed. Okay, you can see it's still there, but on some brokers it will disappear. So what I would do instead is to use the shapes, a rectangle. I'll use a rectangle instead and just mark it up like so. And I really don't need this one then. So this is basically what I would be looking to work with. I mean, you can extend it as much as you want, I don't know, for the whole week if you wanted, but really, what you want to note is which direction the price goes, at the beginning of the week is where it would usually, keep going. I mean, what could be as easy as that? Yes. I mean, sometimes some of these things, seem so easy, but we know it's not always like that. You still have to do some work. At least you just have the guiding principle, as it were, to work with. So this is the high of these two candles, and this is the low. What you now want to do is to see which way the price goes. And you can see here, after this second candle, and obviously, I'm sure you know that it does not have to be, it does not have to start with a bearish candle and then a bullish candle. It could be the other way around. Just any first two candles, whether they are bullish, whether this one is bullish or bearish and the other one, it doesn't matter, just work with the two. So you can see the third candle basically pushed out of that box. You're wanting to push out of the range of these two candles. It pushed out, but it came and closed back in. Like I'm sure with some of the strategies we teach, when price breaks out of the range, this is the range, now this blue rectangle. When price breaks out, you want to be careful it's not a fake out, because it broke out here. If somebody had, jumped in the trade with a buy thinking it's going to carry on up, it just came back and closed inside. And the next two candles basically, were bearish until it began to go up again. So you want it to be that price has broken out of this range decisively. You want it to be that the price has broken out of this range decisively. I mean, preferably, not candles like this, that, show a lack of direction on the part of the market, because, I mean, the wick at the bottom and the wick at the top are more or less equal, which means, price pushed down, it rejected lower prices, pushed up, rejected higher prices. You don't really want to work with that. You want it to be that the price pushes out. And the first candle that pushes out convincingly, the first candle that pushes out convincingly was this one. This one pushed out, but you can see there was a wick. I mean, you want to be mindful of wicks, obviously. The fact that there's this wick at the bottom basically means a rejection of prices, of lower prices, meaning that it's not wanting to carry on down, So let's go with this one. The price did a zigzag, what's it called? Did some oscillation going up and down, no clear direction, and then it pushed out with this strong bullish candle, which obviously would make you think, okay, it seems we are going to move now. So this was the price that broke out of this range, broke out as in break out and close. I usually wait for the close of candles. I obviously would always teach to wait for the price to close, the candle to close. There are times when I would enter a trade, even when the candle has not closed, because I am certain, for some reason, based on what I've seen on the chart, that the price is going to continue in that direction. So I would take an impulse entry. An impulse entry is basically you jumping into a trade when the candle has not closed. But this one closed. Do we just jump in because it closed above? Not particularly. We wait for the next candle to give us confirmation. You could say this is the alert candle, alerting us to the fact that, hey, it seems price wants to go up. That's the alert candle. The alert candle is not always the same as the entry candle. With some of the strategies I trade, the alert candle also serves as the entry candle, but not so much with a lot of the strategies that we teach here. So this one came up. If you are jumped in, guess what happened? The next one basically pushed down until it got here. This is a 4-hour candle. If you were going to be trading with this, if you got in here, by the time this candle closed, you are already in a 58 pip drawdown or so. And I know sometimes, we'll panic and close the trade because we think, oh, a drawdown of 58 pips. But hey, what I'm saying here is with this candle coming out, you want to see what the next candle does. If it wants to continue, if you see it's continuing, then of course, you can then jump in for a buy. We are going to be checking examples with, for other weeks or with other weeks. Week as in W-E-E-K. We're going to be checking, other weeks as well. So this is just example number one. So having seen this one come here like so, I would not obviously have entered. I would not have even waited for. I would not have entered. Here. Let me pull this up. A lot of traders would enter here because, price has pushed. From here, it's been ranging. When the market opened, it began to range and all that. When the first candle pushes up, some traders would jump in, but guess what? It could end up being a fake out like it was here. So I'll wait for the next candle. It so happened that the next candle came down, so I would not have entered. I'll be waiting for another opportunity to jump in. And, it came down here. The next opportunity seemed to have been here. At the close of this candle, some traders would jump in as well, and obviously the market will take your money if you're not careful, except if you placed your stop loss at the right place. If you measure this 22 pips, well, I suppose if you had entered here anyway, round about here, below this swing is where you place your stop loss, you could have won this trade if you entered here because it only gave you a 23 pip drawdown, whereas your stop loss was probably about 60 something. On this occasion, you won. But how about the first one, the first trade? If you entered here, the advisable place to have had, had your stop loss would have been under the swing as well. How much pip difference or how much lower, than the swing low you place your stop loss is another matter, depending on, how you trade or how you ascertain your stop loss. So if you had entered this trade anyhow, and you placed your stop loss here, you could have gotten away with it, because it came as low as 65 before it began to go up. So you could have won this trade, but to be honest with you, most likely I would not necessarily have jumped into this trade unless I considered other things. I'm basically, explaining this now for the sake of those who might not know what other confluence, to add, know what other factor to add as part of the confluence. Confluence basically has to do with having more than one reason to enter a trade. You don't just see a strong bullish candle and you jump in. There's no confluence there. You could jump in perhaps because you've considered that it has broken out of it, well, the price has bottomed. Let's see if this has bottomed. So if you're going to jump in here, it could be because you know that the price has bottomed here, even though it's far away. So that's not particularly good enough. That would not be the best confluence. So what you could do is you could use a trend line. You could connect the lows, the swing lows. If you jump in here, you know if the price comes back to your trend line and breaks below it, it's most likely going to, it's most likely then going to continue down. So you could say, okay, fine. I've seen this strong bullish candle breaking out of this area of consolidation, and I have placed my trend line there. I think I'm good to go. I'm willing to risk however much pips that I have to using a swing low. If I see that the price breaks below the trend line, then I'm out of the trade. So I suppose some people will say trading is about calculated risks. Well, yes, you could say that. However, you want to be sure that you are not giving away too much to the market. You want to consider your risk to reward, because the question is, if you were to take the risk and enter here, placing your stop loss here, which is about 65 pips, let's just say 65, 70 pips away, consider where you would have wanted to take profit, which would be here. Is that a good enough risk to reward? Let's say you want to take profit, there. You want to consider, is that a good risk to reward? So if you enter here, 70 pip stop loss, 70 pip or so, take profit. That's like a risk to reward of 1-to-1. Well, yes, I'm sure some of you who have been with me for longer, you know that I have a strategy whereby the risk to reward is 1-to-1, and it is quite effective. I'm talking about the pip collector, but this is not the pip collector strategy. So I most likely would not be going for a 1-to-1. I want to go, maybe a minimum of 1-to-2. But anyway, let's get back to the strategy itself. All that was just some additional, some extras really. Let's take this one off. Let's now focus on the strategy itself. Then we'll come back to the where to place your stops and all that. Okay. So I would not necessarily have advised you get in here unless you had, confluence. If this is the only strategy if this is the only factor you have to consider to enter a trade, I would say definitely to wait for the next candle to show you it wants to go up. Otherwise, you could decide, okay, fine, this price broke out of here, I will mark this point, because as we might see with other examples soon, there are going to be times when the first candle breaks out and the other candles just continue up. It could be that, you have a candle like this break out, and then you have another candle which pushes up powerfully to the point where it's like you have no chance to even get in the trade. Okay, bear with me. Let's just do something here. Green. Wow. So forget this red candle. Assuming this one pushed up and closed here, and the next candle pushed up powerfully. So it's like, oh, it's like the train has left the station. It has pushed away so far. You don't want to be jumping in, buying here, just in case it pulls back against you. So what you would do in that case is still use this as a possible re-entry, because the market a number of times will give us a second opportunity to get into a trade. So if the first one pushed up powerfully and the second candle goes even more powerfully and you think, oh, it's risky getting in that trade, just wait for it to pull back, perhaps back to this point or back halfway of this candle. Now, I hope I'm not, we're not, giving out too much today. I mean, or what I'm giving today is not going to be too much for you to take in, but we do trade the 50%, retracement. In the sense, when the candle pushes up powerfully, either when it pushes up or pushes down, when there's a move in the market, a big move, you want to wait for a 50% retracement. So if you consider this candle, for instance, from the high to the low, well, to the low here, that would be the low really. All right, let's leave it as this. So when the candle pushes up powerfully like this is about an 86 pip move. Half of that would be like 43. That'll be somewhere here, I think. 43, somewhere there. So if it pushes up powerfully like this and you're wanting to enter on a retracement, you would either let it come back to 50% of that candle or back to where, the breakout candle closed, which will be here. Don't worry, guys, I'll be pausing this soon so that we can take questions, regarding what we've learned so far. But this is how, you would trade it. What I'll do is I will have an example for another week, before, the questions come in. So we've ascertained now that we start off the week on the Sunday night or Monday morning. Maybe for those in the States, it might be Sunday, early hours of Sunday, I don't know, so basically you wait for the first two candles anyhow. And then when price begins to break out of this range, either to the upside or downside, that's where you enter. This could have been an okay entry if you had a good stop loss. Otherwise, you could have waited for the next candle, but this definitely was a good one. Well, sorry, not a good one in a sense. Like I say, unless, except you have a confluence of reasons to enter, then, you could have taken this one. I'm most likely would have taken it because obviously I would have considered the trend line and all that, I could have entered. I mean, if we zoom, okay, yeah, I suppose I could have entered this one. I'm sure some of you can tell why I would have entered that trade. Let me just do this. You're going to have the recording anyway, so you can watch it over and over again, just in case I'm a bit deep for some of us. This is the period separator for this week. I'm going to remove the other period separators. So one of the reasons why I would have entered this trade is because it's bottomed here. The price came and reached, created this low, went up and came back to this almost the same area. So it's bottomed out. When it bottoms out, the only way to go, the only place to go is up. Secondly, we see here that there is structure. I mean, this is where we are talking of entering the trade, but just below it, we see there is structure, equal lows, which obviously tells us that it is most likely going to push up as well. You could also consider some other things. It also, seems to be an inverse head and shoulder. So you can see, I am coming out with multiple reasons why I would have entered the trade, so that I'm not, basing my decision purely on just, what's happening here with the breakout. But for those who do not know, I would say to stick with, the rules. So what we're going to do now is to go to a different week and see if the setup or the price action was different, if the price action played out differently. So let's bring back the period separators. Let's bring back the period separators. So we are moving away from this week now. Let's try this week. Okay. Yeah, I think this is a good example. So this is the week, last week. This is the week before and the week before that. So let's go with this one. Let's go with this week. I would again remove the period separators just so we can focus on this one. Okay, so again, okay, I have to move this or else we will not see where the highs and the low are. So again, we will draw our box considering, let me do this. Let's put that on first. So we are considering these two candles. We will draw our rectangle. That, oops, we want blue, we don't want green. Okay, so that is the high of this candle. Let's make it bigger. We're considering these two. This is the high and this is the low. So let's go with that. So you can see exactly what we're saying. The price just went in that direction without any giving us any difficulty. We didn't have to think too much with this one. So we see here, and guess what? I am praying that you guys would be able to practice it this week, tomorrow morning. I hope the market would not have moved so far away from the box, the range that we are working with. So you are working with the range of the first two 4-hour candles. Note 4-hour candles. You might decide to drop to a lower time frame to seek your entry, but let's work with this one first. If we have time, we'll have a look at that, or if we have a part 2 of this. So we see here, this candle closed. Let's make it bigger. This candle closed outside of the range. Again, we don't just jump in, at the first candle that closes, outside of it. We wait to see what the next one is doing. The other one happened to have been a bullish candle. And then with this one, I suppose you could begin to enter this one. You could have entered here. You could have entered at the close of this candle. And actually, at this point, I want you to unmute and tell me why you would have entered. If you know, kindly unmute and tell me why you would have entered at this candle.
There was rejection.
There was
rejection
at the top.
Yeah,
absolutely. I mean, we see, there was a rejection at the top, and the body of the candle is big compared to the other. So there was some serious rejection here. We're not surprised, that rejection of higher prices, and it also closed outside of the range. The next one also closed outside of the range, even though it was a bullish candle, but we can see, it did not even go as high as the previous candle went. That also is one thing to always consider, when you hear me talk of selling pressure or buying pressure, this tells me the selling pressure is setting in. Why? Because forget all these other candles. Forget all these other candles. All this from here, forget those ones. Assuming this is the candle you saw when you put on your computer. You know, if this is how far the price had gone, you would immediately see that this was the highest candle in this range. The next candle did not go that high. That basically tells you that even though this was a bullish candle, bullish as in the buyers were in control, they were not in control enough. They were not convincingly in control because they could not even take the price higher than the previous candle. And then the next one closed lower, closed lower. Oh, by now you should know there's definitely selling pressure. When there's selling pressure, you want to be thinking of selling. You know, and when there's buying pressure, you want to be thinking of buying. You know, just consider other moves here. Consider other moves here, you know, to explain selling pressure. You will see that each subsequent candle is lower than the previous. And each time it did not go higher than the previous, which means whoever is pushing the price is the one in control. These ones are the ones pushing the price, the sellers. Okay, fine. By the time we got here, the price was now beginning to go up. But even with this one, let's delete this one now. So even with this candle now, it did not go higher than this. You know, if it had gone higher than this candle, because it's been coming down, if it decides to now begin to go up, you want to wait until it breaks, you know, maybe the last strong bearish candle before you say, okay, it seems as though power is changing hands. But like we know, and like we have seen here, this move up was only a retracement. And as seasoned traders like the GWT traders are, we know the market does not go in a straight line. If it's going to drop, it does not just keep dropping forever. At some point, it pulls back. You know, it retraces, almost as though the sellers want to catch their breath before it continues. And that's exactly what happened here. The price moved up, but it only went so far and it began to go down again. So we see that there was selling pressure. So coming back to this one, we want it to be that the price has broken outside of the range, the box range, decisively, and we sell. Now the question is, let's delete this one. Having broken out, where do we place our stop loss? Where do we place our stop loss? We basically will place our stop loss, of course, above the previous swing high. Well, would you call this a swing high? You could use the previous high, or this was definitely a swing high. I mean, this was not exactly a swing high, it's just a high, you know, but you could use the previous swing high, place your stop loss there, you know, maybe, you know, plus, you know, the swing high plus 1 ATR, or you decide what to work with, what pips to work with, you know, and you can see the risk to reward was super. This would have been a good trade, guys. We are believing for the same this week. Seriously, guys, you know, there are people I know. There are people I know who just trade only GU. That is to tell you, there are people that I know who trade only GU, although there are people I know who trade only GJ. There are people I know who trade only gold. But what I am saying is, even if you say, from now on, with this strategy, I'm going to trade only GU, well, I'm sure you will do well. There are going to be times when it doesn't play out quite well, like we saw with this week, like we saw with last week, whereby it was a bit of a tricky one. It would have required some patience on your part, which basically means, I mean, think of it, each candle here is a 4-hour candle, which basically means you might not have been able to enter a trade decisively until Wednesday. Now, who has time for that? Who wants to keep their hands folded Monday and Tuesday, the whole of Monday and Tuesday, and wait till Wednesday, maybe even Wednesday afternoon before going into a trade? As a matter of fact, if you are waiting strictly for a breakout and a continuation, you will not have been able to enter a trade until Thursday. That's Thursday. The week is almost over, although, from Thursday, you would have then gotten all your profits, almost 100 pips. I mean, I'm sure anybody could do the 100 pips. There are some people who are just wanting to get 20 pips for the whole week because they don't have a strategy or, but 100 pips for the week is good. So there are going to be some challenging weeks. That is why I usually don't advise. I mean, as clever and as wise as it might sound, I don't think you should focus on just one pair. There are some people that will swear and say, no, just one pair. You don't need more than one pair, just one pair. What then happens with situations like this? That's why I would not focus on one pair. I mean, yes, there are times when I've just traded any pair that gives me the opportunity. The other times I've narrowed it down to 4 pairs. There are times I've said 8, but I don't think I would ever trade one pair, because if unless you have a different strategy, but this week was beautiful. It basically just, I mean, by Tuesday, I mean, this day is Monday. By the end of Monday, you were already like in a trade in a sense. And it basically went and gave you, wow, over 200 pips, because this period separator is the end of the week. So if you got in here, or even if you got in here, maybe you still were not sure here, you got in here, by the end of the week, you would have gotten over 200 pips from this. Maybe you didn't catch all the 200 pips because, at some point when the price was here and began to go back up, maybe you would have come out of the trade. But guess what? You would have been able to continue here again and get even more pips. So we're going to, look at more examples, but I want us to, basically take some questions and, your observations as well, before we carry on. Yeah, so we'll do that. Okay, so we're going to check other weeks now. Let's just, okay. I mean, this was not, this is an example of a bad week. I mean, maybe if you go to a lower time frame, we're going to do that. You could have been able to get some pips because the range, if you consider the low to the high, the range was about 80 pips. Yes, you could have been able to get some pips for the week, but if you were going to trade strictly with this strategy and you don't know any other way to trade, it would have been difficult. Let's just mark it out anyhow. We consider the first two, oops, where is it? We consider the first two candles. I mean, we have extended it. Now, I hope my internet is not going to start playing up. We have extended it, but obviously we know we're not considering all this kind. We're just considering these first two. So here, for instance, it broke out. You are thinking, do I jump in? I would not jump in. Why? Because there is rejection there. I mean, whenever there's a week, you want to be careful. If it's a small week, fine. But even then, we want to usually wait for the next one. So you can see it was just oscillating, going up and down. The only time it kind of like went above was, from here. So this would have been a good place to enter. We see, there are wicks here. There's a wick here, but the wick is rejecting lower prices, which means it wants to push up. You could have been able to enter. You could have been able to enter, and you could have captured about 30 something pips or less. I mean, when I say this is how much you could have captured, that's because that's how much the market gave us. I mean, it basically, well, it is the case that you might not have cut it, you might not have cut everything, but at least, you'd have been able to catch something. I mean, the way I would do it, okay, my internet is going in and out. I hope you guys didn't miss what I just said. But anyway, I mean, we know what we tend to do. We know what we tend to do is to target a previous high. Now, another example, this is a good example as well, where we might not necessarily have taken the trade for this week. Why? Because it's coming to the high. There's nothing to tell you necessarily that the price is going to move and break the high. So on this particular week, I would have suggested you stay out, or perhaps just know that if you're going to trade, you're going to capture just a few pips, not everything. So getting into the trade here, for instance, placing your take profit there, you could have been able to aim for about 50 pips, even though on this occasion you didn't get it. So what you then would have done, because you can see all week it was just going in that range. It was just going in that range. However, the week after that, it played out a bit better. Well, not really better, but it basically broke out of the box and was just creeping, really. This was a bit of a tricky one to get into, because when the candles are small like this, it's a bit of a tricky one. I suppose, if anything, if you were going to enter, this is where this is where you would have entered. Because there was a rejection at the top, you could have said to yourself, okay, fine, I'll come in here, place my stop loss there, about 60 something pips, and it would have carried on going up and gone down eventually. So let's just look at one more week. This was another good week. This was another good week. I mean, this basically happened on Monday. It happened on Monday. It went up like that. It basically pushed out like so. I mean, if you had other factors to consider and you decide to enter here, that would have been a good entry. But if you decided to enter here, that would have been good as well. So you can see eventually it pushed down, but you would have placed your stop loss here. You would have placed your stop loss here about 90. Well, if you wanted to have it that low, or perhaps you want to have it this low, about 80 something pips for about 160 something. That is like 1 to 2. So you can see, guys, it is a powerful strategy. It's easy to trade. That was this week. Guess what? How about the week before? This is the last one we would do. How about the week before? Again, we see, it basically just came out straight away. I mean, this one came out, there was a wick at the bottom. You would have thought to yourself, I don't know about this one. Maybe I'll choose to enter. Maybe I'll choose to enter here and place my stop loss here. 70 pips. over 100 pips or so, that would have also been a good one. So you can see, guys, this is perhaps one of the easiest strategies that you have learned at GWT. I would say one of the easiest strategies. We obviously have other strategies, but like we don't want to just keep on teaching strategies, because you don't want it to get too much until you have mastered, so much strategy. There's really no need learning even more. Absolutely, this is a good one, but obviously you want to combine it with other strategies so you can trade other pairs as well, and not just GU, the cable. Okay, so basically the question is, how would we trade it on a lower time frame? Let's go back to the higher time frame first. So this is the 4-hour time frame. This is the 4-hour time frame. How would we trade it? So this is the beginning of the week. Let's just mark this one here. As a matter of fact, let's mark the beginning of the week to the end of the week. And we are going to remove the previous separators from the others. So we know we're going to go to a lower time frame and see how we would have entered on the lower time frame, maybe on the 1 hour. So let's go to the 1 hour time frame. Let's go to the 1 hour time frame. We're going to that place where we marked. That's the end of the week. That's the beginning of the week. Okay. So we can see, this is the same range as drawn out on the 4-hour time frame. We are waiting for a break above or below the box. This is the one that gives us that break. Now, because there's a huge wick at the bottom, you might decide to enter here. You might decide to enter here, but you want to play it safe. You want the next candle to paint as well. So you could say, okay, fine, I will enter here at the close of the second candle, the second breakout candle, and place your stop loss here. Place it below the low of the candle. And you can see when the price broke there, it basically came back, it pulled back, slightly, went up, did all that, but ultimately it went up. And we were able to capture at least 90-something pips. If you decide to come out at this, with this consolidation, at least you would have captured something. You might not always be able to capture all the pips that it gives, but being able to capture some of it obviously does help. I mean, you can see what's happened here. You can see what happened here. If we got in, we're able to stay in all that time. We're able to have the market give us well over 180 pips. Now, I want us to go into this week, guys, and just do justice to this strategy. If it plays out, if it gives us the right opportunities, I want us to milk it, and get the most out of it. Okay, so I mean, basically that is it for this session. I mean, as usual, watch the video, over and over again if you have to, and I'm sure you would be able to make some good profits in the market. Otherwise, when we have our next training or trading session, you could ask questions and we will tackle them then. Okay, now, God bless.